Hey guys, Peter Harper, Managing Director and CEO of Ascena Advisors. For those of you not familiar with the vlog, Ascena Advisors is a multifamily office that assists foreign families that own operating businesses in the US and invest directly in US operating assets. So I've been offline for the last couple of weeks, primarily because we have been focused internally on how we transition from where we are today to the next stage of the crisis recovery. And internally, our core focus has been on three things. The first is cash flow. When this crisis first evolved, we were specifically looking at the stabilisation of our own cash flow and that of our clients. For our clients, their focus when it came to their investments was directly attributed to cash flowing assets. So while there's been a lot of opportunity in the equities market to chase substantial capital growth, most of the team have still been focused on yield, so that if the market does go down again, we're still well placed to weather out the storm. The second is on OPEX. So when I think particularly over the last 6 to 8 weeks, as we saw most federal governments around the world deliver extraordinary levels of stimulus to businesses of all size, we saw a change in approach where a lot of folks just accepted the status quo and probably weren't as aggressive as they should have been around how they managed operating expenses. Some of that might have been directly attributed to the direct requirements of the stimulus measures. But I think if people want to come out of this next stage of this crisis recovery and be in a good position to maximise the opportunity that might come out of Q3 or Q4 of this year or Q1 of next year, then cutting bloat is an absolute essential. And the third thing, and this has been largely a focus through discussions with our clients, is really understanding risk-adjusted returns, right? So there is a lot of noise being made right now, and the bull market and how quickly the stock markets all around the world have recovered, and that has been for the most part driven by the extraordinary stimulus measures that have been poured into markets all around the world. But there's also recently been, I think, a very significant change in consumer sentiment, right? In this sense that, hey, we're not going to go back into lockdown, the economy's out, and folks are going to get back to spending, right? And I think you saw this when we saw the unemployment numbers in the US being lower than it was originally projected. There was this outweighted response by the market going, okay, this is not a UW, this is a V-shaped recovery, and the markets are 100% behind that. The challenge is there is a lot of fundamental evidence, right, that's in the private markets, so that's not necessarily directly impacting the public markets, that does not necessarily support such a rosy outlook, right? So when everyone's going all into the public markets, do these investors actually have a good handle on the level of risk they're taking, right, when they're going into the market? How different is this to the euphoria that existed around Bitcoin when Bitcoin was blowing up, last year, the year before, and it looks very similar, right? So for us, we're doing what we always do. We're focusing on yield, right? If you invest for cash flow, invest for yield, and you're focused on making long-term decisions, then ultimately you're going to come out of this in front. So 3 things: get your cash flow organised, whether that's in business or as a private investor. 3, get your operating expenses culled and cut the bloat, because the free stimulus is about to go away and you don't want to just take on unnecessary debt. And 3rd, understand the risk-adjusted returns you're taking on. Thanks.